Hello everyone. So today we are going to cover the Unit 5 of the Level 3 Diploma, that is Finance and Business. So this is Unit 5 in which we discuss the different financial concepts in the business and how they are helpful to run the business in a successful manner. So the first learning outcome is to know about the business finance. So there are different reasons for keeping the financial records. The first reason is the legal requirement. The businesses always keeps the financial records because it is legal requirement for the companies. The first is the business planning. The financial records of the companies are always important for any effective planning of the business. For example, if you are going to launch the new product or service in the future, then you have to check your financial records. You have to check your financial position. So it is very important in the business planning. Then we have another reason to support a loan application. When companies have to ask for the loan, then they must have the financial record. They support the loan application by providing by providing the financial transparency with the help of their financial records. Then, to prepare the budgets, it is important to have the records of the different financial statements of the company. It helps to prepare accurate and realistic budgets. Now we have the second assessment criterion, which we explain the purpose of the business accounting. So we have different purpose of the business accounting. The first purpose of the business accounting is to provide the accurate financial information for every stakeholder of the company that would helpful to understand the financial health of the company. The second purpose of the business accounting is to monitor the financial performance. It helps by tracking the revenue, expenses, and the profitability over the different time periods. Then the business accounting also allows the businesses to monitor the overall business performance of the company, and it ensures that the company meet the financial and operational goals. Then the fourth purpose is that it supports in decision making. It provides the essential data to guide the strategic and operational decisions. So we have different type of businesses. The first is the sole trader, the second is the partnership, third is the private limited company, and then we have public limited company. Now I'm going to explain these different type of businesses one by one. So the first type of the business is sole trader. In the sole trader, there is only one owner. So in sole trader, the companies maintain the record and maintain the record of the income and expenses, and they submit a self-assessment tax return because there is only one owner, and it keep the basic financial record for the tax purposes. Then we have the partnership, in which there can be two or more than two partners. In the partnership, the companies obviously record the income and expenses for the partnership, right? And they file a partnership tax return. In the sole trader, they file the self-assessment tax return, and when there is the partnership, they file the partnership tax return, and each partner have to report the profit and losses on the personal tax return. Then we have the public limited company, sorry, private limited company. In private limited company, the companies prepare the annual financial statement, and in private limited company, they file the corporation tax return, and they submit the accounts to the company's house. Then we have public limited companies. In public limited companies, the companies produce audited financial statement, and they make the financial reports available to the public, and they comply with different FSA regulations and file with different house companies. Now we have the fourth assessment criteria, in which we state the different type of businesses finance at different stages in the growth of a business. So now we have the different type of business finance. Here you can see also in the picture the different type of business finance. So the first is the own capital, the second is the retained profit, The third is the bank loans. Fourth one is the venture capitalist, and the fifth one is the crowdfunding. Now I am going to explain these types one by one to you people. So first one is the own capital. Own capital is basically the startup stage of the business, and at this startup stage, the business often rely on the personal savings or investment of the investor or the entrepreneur or anyone who is starting the businesses. The second one is the retained profit. Whenever businesses started growing, then we have the retained profit from our operations and we can reinvest this profit to fund our expansion. So this is the retained profit type of the business finance. Then we have the bank loans. During the growth stage, the businesses may seek the bank loans to finance its larger product to expand its businesses. Then we have the venture capitalist. When the business is at the more advanced growth stage, then it might attract the venture capitalist that can help in the larger investment to the company. Then we have crowdfunding. In different stages of the company, the businesses can also use crowdfunding platform, which can help them to raise the small amount from many investors or brokers. Now we have the fifth assessment criteria in which we explain the different type of accounting and financial statement. So we have different types of accounting and financial statement. The first one is the balance sheet. Balance sheet basically provide the clear picture of the assets, liabilities, and equity of the company at the specific date, and it is important to evaluate the financial stability of the company. Then we have profit and loss statement. The profit and loss statement basically summarize the revenues, expenses, and net income of the company, and it is used to evaluate the profitability and operational efficiency of the company. Then we have cash flow statement. The cash flow statement basically shows the total cash flows, the total inflows and outflows of the cash categorized by operating activities, investing activities, and financing activities. And it is important to manage the liquidity and cash flow of the company. Then we have the budgeting. It forecasts the future income and expenses of the company for the future financial planning, and it is helpful to set the financial targets and monitor the performance of the company. Now we have the second is learning outcome of this unit, in which we will learn to record the financial transactions. So the first assessment criteria is to demonstrate the accurate use of the double entry accounting system. We have the different features of the double entry accounting system. The first one is purchase, second is sales, then we have returns, then we have cash and bank, then we have trial balance. Okay, so now I will try to explain the double entry demonstration to you people to make this concept clear. For example, there is the business and it is making the sale of $500 in cash. It buys the office supplies for $200 on credit, and it also pays off $100 from that credit. So now here is a double entry demonstration. You can see that there we have the cash account and sales revenue account. In cash account, the $500 is debited, and in the sales revenue account the $500 is credited, because we have the cash of $500 in our account, or we can say that we have in cash of $500. So we pay this $500 to buy any supplies of the officers. So in the sales revenue account, we are using this $500 for our sales. So this $500 is credited in this sales account. Then we have the office supply account and account payable. In office supplies account, $200 is debited because we have to pay this $200 to the supplier because we have purchased the office supplies, right? And in our account payable account, $200 is credited because in our account payable we added that $200 amount that we have to pay in the future to our supplier. Then we have other two accounts. The first one is account payable and the second one is the cash payable. So we paid $100 from that credit. So this $100 is debited from our accounts payable account, and from our cash account the $100 is credited. Now we have the second assessment criteria in which we demonstrate the bank reconciliation. So now I'm going to explain these features to you people one by one. The first is that it is receipts credited by the bank. It is all the money received by the businesses that is credited to the bank account by the bank, and it is payment debited by the bank. So it is all the outgoing payments made by the bank are debited from its bank account by the bank. Then it is the transaction errors. It can be the error that occurs when we are recording the transactions either by the businesses or either by the bank. Then we have the balancing error. It is to balance the business's cash book or the bank statement that can result in differences that must be reconciled. So we have different step for reconciliation. First one is to compare the receipts. The $5,000 receipts is correct. This is the same amount that is credited in the both bank statement and in the cash book. So there is no issue. Then we have to compare the payment. So the cash book shows the payment of the $3,000 while our bank statement shows $2,800 payment. So there is the difference of $200. Here you can see the next step, that is identify error. In next step we have to identify what is the basic error in our bank statement. So when we investigate, it turns out that the $200 payment was recorded in the cash book, but it was not yet processed by the bank. So this is an outstanding payment. Now we have fourth step, that is we have to adjust for errors. We have to adjust our cash book or our account for the bank's processing delay, and we have to note that the reconciliation is balanced once this $200 is cleared. So here is the bank reconciliation statement. It is basically demonstration of the data that we have already discussed in the previous slide, that we have the outstanding receipt of the receipt credit by the bank was 5,000, and we have now balance as per cash book is 3,000, and when we reconcile it we have the reconciled balance that is $2,000. Now we have the third assessment criteria of the second learning outcome, in which we develop different control accounts for account receivables and account payables. So first we have to understand the feature of the control account. There are different features. First is balance brought down, second is sales and purchase, the third is irrecoverable debt, and fourth is refunds. So the first one was balance brought down. It is basically opening balance of the amount that is due or owed from the previous period that are carried forward. Then we have sales and purchase. It is basically our sales, that is account receivable, and our purchases, that are account payables, and these are recorded in the control accounts. Then we have irrecoverable debts. Irrecoverable debts are basically bad debts that are written off, and it reduces the account receivable balance. Then we have refunds. Refunds or returns always adjust the account receivable and payable balance of the company. Now we have the development of the control account. For example, the balance of the company was $5,000 and the sales of the company was $10,000. It was the sales of the company, so it is included in the debit section. Then there are refunds of the company. For refund, there are $500 that would be credited in the company account. Then there are irrecoverable debts, that was $300, and it would also be credited in the company account. So there is the cash that company received from its debtors, and it would be total of $800, and the total debit account of the company would be $6,200. Now we have accounts payable control account. In accounts payable control account, we have the balance of $7,000, purchases of $9,000, and the payments to the creditor is $10,000, and the refund that we have to take from our suppliers was $200, and we have the total balance of the control account that would be $6,200. Now we have to demonstrate how to correct the error in accounting record. For example, there is the business XYZ that made the following transactions, but it recorded them incorrectly. For example, the credit sales of $1,000 was recorded as $100 in the account receivables control account. So the payment of $500 from a customer was not recorded in the cash book. Now there is the incorrect entry of $300 that was posted to the account payable of the company, and it caused the mismatch. Now we have to identify the errors and update our control account. So the error was the credit still recorded as $100 instead of $1,000. So in correction, we have to update the account receivable account with an additional $900 to reflect the correct sale amount, that was $1,000. The second error was the missing payment from the customer. We have to record $500 payment in our cash book, and we also have to update the account receivable control account to reduce our outstanding balance. The third error was the incorrect entry of $300 in the account payable. So we have to remove $300 error, and we have to adjust our account payable control account accordingly. Now here is the updated control account, in which we have the balance of $5,000, we have the sales of $900, and we have the payment that we received was $500. This is our updated control accounts of account payable. Here you can see the credit amount and debit amount and the total control account payment. So it is important to correct the errors practically. We identified and we corrected the under recorded sales by adding $900 to account receivable, and that missing $500 payment from the customer was entered into the cash book, and we also updated it in the account. The $300 payment error was in the account payable, and we adjusted it to reflect the true balance. So the reconciliation statement was prepared to ensure that all these corrections were accurate and all the books were balanced. Now we have the third learning outcome, in which we will get to know about the cost and management accounting. In first assessment criteria, we have to understand how absorption and marginal cost is used for decision making. So first we have absorption cost. It includes all the fixed and variable cost in the cost of production, and it is very useful for full cost pricing decision. Then we have marginal cost. It only includes the variable cost, and it is considered for decision making, providing the insights into only short-term profit contribution. Now I will explain these features one by one. The first was the allocation of variable and fixed cost. So the both absorption and marginal costing methods involve the allocation of both variable and fixed cost. And through the absorption costing, we can allocate all the cost, and with the help of the marginal costing, we can focus on the variable cost only. The second concept was the stepped cost. It is the cost that remain fixed for the certain level of production, and it can increase in steps as our production exceeds the certain thresholds. Then we have the cost center. It includes all the department or all the business sections of the company where the costs are accumulated for allocation or for the evaluation. Now I will try to explain that how marginal costing is useful for decision making. So, it is important in short-term decision making. It helps in making the quick decision by focusing only on the variable cost. And the second thing is that it has its contribution analysis, and it evaluates that how much each product contributes to cover its fixed cost and generating the profit. And it is also helpful in the break even analysis. It simplifies the calculations of the break even by only considering variable cost, and it make it easier to set the sales target. Now it is also helpful in pricing for special orders. It assists in the special pricing orders, and it ensures that they cover the variable cost and contribute to the fixed cost. And again, it is very helpful in product discontinuation and decisions. So it helps to decide whether to discontinue the product of the company by focusing on whether it covers all its variable cost or not. And it is important in the cost control also. It separates the variable and fixed cost by providing the better insights into how production change the impact profitability. Now we have the second assessment criteria, which explain how budgeting is useful for financial planning. So the fixed budget is the set of amount that is allocated for specific activities of the company remaining unchanged regardless of activity levels of the company. Second is the flexible budget. It always adjusts according to the changes in the different business activities of the company, and it allows for more accurate financial controls. Then we have master budget. It usually combines all the individual budget into the overall plan, and it guides the financial objective of the company. Then we have the budget allocation to cost center. It basically assigns the specific budget amount of the company to different departments or sections to track or control the expenditures of the company. Now I will explain that how this budgeting is useful for financial planning and controlling. So it helps to allocate the resources efficiently to meet the goal of the businesses. It also provides different financial framework for future planning and forecasting. It is also helpful to monitor the actual performance of the company against the projected figures. It also helps to identify the different areas for the savings and cost control of the company, and it is helpful to assist in setting the different financial targets of the company for its department and projects. And it also ensures the transparency and accountability in the financial operations of the company. Now we have the third assessment criteria in which we will explain that how to undertake the investment appraisal. So we have different investment appraisal techniques here you can see in the picture. The first include the net cash flow, then we have payback period, then we have net present value, and then we have return on investment. So what is net cash flow? Net cash flow basically measures the total cash inflows of the company minus the total outflows of the company over the specific period to evaluate the liquidity of the investment. Then we have the payback period. It calculates the total time that is required to recover the initial investment from the cash inflows of the company. Then we have the net present value (NPVs). It used to evaluate the profitability of the investment by calculating the total net present value of the future cash flows of the company minus its initial investment. Then we have ROI and or return on investment. It basically assesses the efficiency of the investment by comparing that investment to the net profit of the company to the initial cost of the investment. So the first assessment criteria is to produce the accurate absorption and marginal cost So we have the absorptional and marginal cost statement. I am trying to explain this from the example. Let's say that we are making the 100 units of a product. In this 100 units, the fixed cost include the $2,000, which include the factory rent and salaries. Then we have variable cost, which is $5 per unit, which include raw materials and labor. And we have selling price of $10 per unit. So here is the absorption cost statement. The fixed costs include all the units, for example, the total 2000, and we divide it by the 100 units. So we have the $20 per unit. That is our fixed cost. Here you can also see it in the table. And we have the variable cost of $5 per unit. So the total cost per unit when we add this fixed cost and variable cost would be $25 per unit. Now we have the marginal cost statement. In marginal cost statement, we in fixed cost we ignore it in unit cost and we treated it separately. So we have the variable cost that is $5 per unit. Then we have contribution per unit that is $10 of selling price, and we minus the $5 of variable cost from this, and we got the $5 per unit. Now we have the next assessment criteria in which we calculate the sub and overall variances. So first we have to understand what is subvariance and what is overall variance. So the subvariance is the breakdown of the total variance into the individual components, and it is helpful to identify the specific areas of the cost control. And in the subvariance we can easily track where things went over or under the budget. And in overall variance, the overall variance always represent the total difference between the actual cost and the standard cost. It combines all the subvariances into the single figure of the variance, and it shows whether the company is over or under budget. Now we have some calculations. For example, let's assume that we have got the following standard and actual cost for the product that we are manufacturing. So we have the material cost. Material cost is $4 per unit, and we expect to use its 2000 units. So total cost would be 800. 4 multiplied by 200 equals to $800. And we have the labor cost that would be $10 per hour, and we expect to use 50 hours. So when we multiply $10 with 50 hours, so we got $500 total cost. And then we have the actual cost. An actual cost, we expect that we use 200 unit, but actually we use 220 unit, right? And per unit cost $5 each. So we have $1,100 material cost. And in actual, the labor cost, we expect that we use it for 50 hours, but in actually we used it for 55 hours. And our labor cost actual was $12 per hour. So the total labor cost that is actual is $660. So there is a difference between the standard cost and the actual cost. So this is the table that shows the subvariances. For example, the first variance type we have is the material price variances. Here is the formula that how we got it, and here are the results. You can check it's this full table. We have this formula, and we calculate all the variances by using these formula, and there are the calculations of all the subvariances, and here we have the result of all the subvariances. Now we have the overall variance. This is the table for the overall variance. Again, we have there in this section, we have the variance type, and we have the calculation for the variance type, and we have the result for the overall variances. Now we have to prepare accurate and subsidiary budget. Now here we have the example of the accurate budget. For example, that we are preparing the budget for the small business. So for example, we sell 1000 units of a product, and our forecast is based on the solid research, that is sales history or known cost. So our sales revenue, if we expect it, so our expectation is that we will sell 1000 unit, at the rate of $50 per unit. So we can have the sales revenue of $50,000. If we include variable cost in it, so let's suppose that variable cost is $30 per unit and the total units that we are producing is 1000 units. So when we multiply it, we got the variable cost of $30,000. When we talk about the fixed costs, that are our rent and our salaries, so let's suppose that the fixed cost of the business is $10,000. So this is the example of the accurate budget. For example, our total sales revenue was 50,000. This is our variable cost. This is our fixed cost. And when we get their total, then it is $40,000, and we have the profit of $10,000. So this is an accurate budget, and it is very realistic. It is well researched, and it always gives us the clear picture of the overall performance of our business. Then we have the example of subsidiary budget. For example, that we are preparing the smaller budget for different department or activities of the company that will feed into the overall master budget. So this budget always focuses on the production side. For example, we have the material cost. We have $20 per unit and we are producing total $1,000. So we have the material cost of $20,000. And if we talk about the labor cost, then the cost of the labor is $10 per unit and the total units that we are producing is 1000 units. So the total labor cost is $10,000. So here is the table that shows the subsidiary budget. The material cost is $20,000, the labor cost is $10,000. So the total production cost is $30,000. Then we have the marketing budget. Next, we will prepare the budget for our marketing department. For example, at advertising, we spend $2,000 for online ads. For promotions, we spend $500 for discount. And here is the table that is showing the overall marketing budget, that is advertising $2,000, promotion $500, and the total marketing cost is $2,500. Then we have the sales budget. For example, our expected sales volume is 1000 unit at the rate of $50 each. So we have the total revenue of $50,000. Here is the table that is showing the sales revenue. So now we have the next assessment criteria in which we apply the investment appraisal method to alternative capital investment option. So first we have to understand the different investment appraisal techniques. We have net cash flow, we have payback period, we have net present value, and we have return on investment. So what is net cash flow? I have already explained the definitions of these techniques in the previous slides. Now I am going to explain these things with the help of example. So for example, that we are considering a project that require the initial investment of $50,000. So here is the net cash flow of over that initial investment. In the first year, we have the cash inflow of $20,000 and our initial investment was $50,000. So to get the net cash flow, we have we have to minus the initial investment from the cash inflows. So when we minus these two things, we got the net cash flow, that is $30,000. And for example, in the next year, we have the cash inflows of $25,000 and now we have no initial investment. So when we minus the initial investment from the cash inflows, we got the $25,000. And same we did for the year 3 and year 4. So by doing this, we have the total net cash flow, that is $60,000. Now, there is a net present value. For example, that the discount rate on our same project is 10%, and we expect that the cash inflows for our 50,000 $50,000 project would be this is the table. So, for example, that the cash inflow of the year one was $20,000 and the discounted rate was 10%. When we apply this discount factor to the cash inflow, we got 0.909, and when we multiply these both, we got the discounted cash flow, that is $18,180, and we did same for the next year, and we got the total present value by adding all these discounted cash flow, that is $85,265, and then we subtracted from our initial investment, that was $50,000. So we got the NPV of 35,000 $35,265, and our NPV is positive, which shows that our project would be beneficial for the company. Now we have the return on investment. Using the same project, now we can calculate the ROI. For example, the total profit of our project was $10,000 that we got by subtracting the net cash inflow from the initial investment. We have the formula of return on investment, that is total profit divided by total investment multiplied by 100. So here we have applied this formula. Here we have the total profit, that is 10,000, and here we have the initial investment. When we apply this on the our formula, we have got the ROI, that is 20%. So return on investment on our project is 20%. Thank you so much. This is all about the Unit 5 of the Level 3 Diploma in the Business Management. If you have any question, please feel free to ask. Thank you.